Adjusted for Risk podcast from the shores of South Lake Tahoe. So we are back to good news is bad news. Markets are reacting to how economic data will impact the Fed's upcoming decisions, which is resulting in the mantra, good news is bad news for markets. And really, this is no surprise. This has happened many times before for markets. And prior to the hot July jobs report that came out today, August 5th, the day that we're recording, where non-farm payrolls jumped 528,000 and the unemployment rate fell to 3.5%. Some economic data was soft, particularly previous job reports, and equities posted solid gains on the assumption that the Fed will start to ease their rate hikes, being less aggressive, and potentially cut rates as soon as 2023. The hot July report, jobs report, turns the tables and places additional pressure back on the Fed, which may result in them continuing their 75 basis point hikes in September. So this good news and is bad news environment is also resulting in mixed signals from equity and fixed income markets. The bond market is waving the caution flag, which we're going to discuss here shortly more in the staying sharp segment. While the equity market has turned in a solid 14% return since its June low. So what are we to make of these conflicting messages? Did that June low mark the bottom for equities, or are there still rough seas ahead, like the bond market is currently signaling? Joe Weisenthal of Bloomberg had a great piece in his daily newsletter this week about the deepening inversion between 2-year and 5-year treasury yields. So while equities continue their strong recent performance, there have been some recent economic data releases that indicate the Fed may be able to perform a soft landing, which will definitely benefit equities, which I think is also pricing in a soft landing. Q2 earnings have been better than expected, with 75% of the reporting companies posting better than expected earnings, while the year-over-year earnings growth rate continues to climb each week. Ending today, August 5th, the year-over-year earnings growth rate came in at 6.7% compared to 5.8% last week. So conversely, markets were forecasting interest rate cuts in 2023. And we're getting signals from the bond market that tougher economic times are ahead due to the tighter monetary policies. We're also seeing this play out in the labor market as jobless claims have been inching upward and jolts, or the number of job openings out there, fell. We're also seeing this as companies announce pause to their hiring and job cuts. So even though we have this really solid equity rally of 14% from June lows, which is a very promising sign for equity investors and might get some to wave the all clear flag, I still think it's a little too early, and you cannot ignore the messages that are coming from the fixed income markets, which we're going to discuss shortly when it comes to the inverted yield curve. So moving along to staying sharp. So I mentioned it earlier about the inverted yield curve, and a lot has been made about the inversion of the treasury yield curve recently, as the benchmark for bond yields continues to fall deeper into inversion. And the joke goes something like this: an inverted yield curve has predicted every recession since before time. In reality, it's predicted the 6 recessions since 1978. Now, in a vacuum, And inverted yield curve isn't the direct cause of a recession. The theory really goes something like this. First, there's three potential theories here. The first one is, as the Fed hikes rates, borrowing costs on everything from mortgages, car loans, small business loans, it all increases. Banks make money on these loans by borrowing on the short end of the yield curve and lending on the long. So when the yield curve flattens, the margins of financials or banks shrink. Furthermore, banks have very little incentive to make loans when long-term yields are lower than short-term yields. This reluctance to lend cuts the money supply and consumer spending, leading to an economic slowdown. Okay. So there's the primary one, and the one that I tend to follow more than these others two. So here's the second theory. If the 10-year yield, 10-year yields are lower than 2-year yields, then the market is forecasting the Fed will cut rates in the future to support the economy because it's concerned about a possible recession. So if the market is pricing in rate cuts due to recession fears, which is really the case today, the yield curve inverts and is basically forecasting a recession because the Fed, because markets are forecasting the Fed is going to cut rates due to the slowing economy. And lastly, maybe we as investors talk it into existence, kind of like when I was in college and I used to sleep with my textbooks, hoping that maybe I could absorb or talk myself into getting a better grade. Since the inversion of the yield curve is such a big deal in the investment community, we may talk it in a recession into an existence. Do we start to believe that economic expansion is long in the tooth and nearing its end, and as a result, begin to get more defensive in our investing and spending, which eventually pushes the economy into a recession? If we think the economy is slowing, all of a sudden we start, slowing our spending, which eventually leads to a recession. So while some may not believe in the theories I listed above, that an inverted yield curve predicts a recession, I do believe investors should take it seriously, but they shouldn't panic and make drastic changes to their current portfolios or their allocations. The inversion indicates tighter financial conditions, yes. And those financial conditions are on the horizon, which will likely slow the economy. It is important to know that a recession doesn't immediately follow the inversion of the curve. In some cases, the recession doesn't commence until 20 months after the curve inverts. And I think an inversion of the yield curve should be looked more as a warning that the current cycle may be nearing an end as tighter monetary policies begin to take hold. However, it's important to note equity gains can still be made during the early months following the inversion. For example, over the past 7 inversions, the S&P 500 index averaged over 10% gain during the 252 trading days that followed the start of the inversion. So those are 10% gain that you don't want to miss out on just because the curve inverts on day one. The curve has been inverting for a while and equities have performed quite well. So again, it goes back to that I've been saying for a long time. Don't get over your ski tips. Don't make harsh decisions based on something that's happening today. Take a bigger picture. Don't lose sight of the forest through the trees. Stay true to your investment objectives and your financial plan and think long term. So moving along to Nauman's musings. I am not a jet setter by any means. Before the pandemic or after, I like to travel, but I never traveled. In fact, I've never been outside of North America. I know I'm a little sheltered there. And while I would make an annual trip back to Wisconsin or other parts of the Midwest with my son to see family, I was never really racking up the miles. So the lack of ability to travel during the pandemic never really impacted me all that much, like maybe some who travel a lot prior to the pandemic. But I guess it helps when I live in arguably the most beautiful place in the US and the adventure awaits right outside my door. But the inability to travel during the pandemic never really got me down. However, after the past 2 months of amazing travels with family and friends while meeting amazing new people along the way, I have realized how much was missed during those years of reduced travel. For me, that reduced travel is really about 2 years of no or to little traveling or flights to see family and friends. And I guess you don't really realize what you had until it's gone or taken from you, right? So I know air travel is a mess right now, but I cannot recommend enough for people to get back out and to see friends, family, and meet new people, especially during these times. It's so refreshing and good for the psyche to be able to get out and make memories with family and the new friends that you meet along the way. While I don't necessarily recommend a YOLO or you only live once investment strategy that some do, I do recommend a YOLO outlook on life. So with that, I am out and I hope you all have a great week. Remember, you can read more of my insights at A Wealth of Insights from 6,237 feet.com and catch all of my Adjusted for Risk podcasts on YouTube, as well as Spotify and other distribution channels that you catch your other podcasts. So with that, thank you very much. And I hope you all have a great week ahead.